Welcome to Unlocking the Upside, the podcast that explores the hidden patterns and processes behind investment excellence. I'm your host, Jeff Robertson. Today, we're diving deep into what might be the most important edge in investing, one that doesn't show up on any Bloomberg terminal or quarterly report. We're talking about the power of compound learning and systematic habits in building investment excellence. You know, it's fascinating, and we spend countless hours analyzing compound returns in our portfolios, but how many of us apply that same principle to our own learning and development as investors? Howard Marks didn't become Howard Marks overnight. Ray Dalio didn't just wake up one morning with his principles fully formed. They built their edge systematically, day by day, year by year. In this episode, we'll unpack how the world's top investors build their learning machines. We'll explore the hidden systems behind their success, from Charlie Munger's mental models to Julian Robertson's legendary analyst training program at Tiger Management. And most importantly, we'll break down how you can apply these same principles to build your own compound learning advantage. Whether you're a seasoned portfolio manager or an analyst early in your career, this episode will challenge you to think differently about how you approach your own development as an investor. So let's dive in and explore how systematic habits and compound learning can transform good analysts into exceptional investors. This is Unlocking the Upside. Investment success is often portrayed as a game of genius and gut instinct. But here's something that might surprise you. Research shows that systematic learners outperform naturally gifted investors by 3-1 over a 20-year period. Today, we're exploring how building learning systems, not raw talent, drives exceptional returns.
That's fascinating, and it reminds me of Howard Marks' journey. His memos since 1990 weren't just market commentary. They evolved into this incredible learning system that transformed his investment approach.
You know what's really interesting about Marx's evolution? His early memos focused on basic market conditions, but as his knowledge compounded, they developed into these deep explorations of market psychology. It's like watching compound interest work in real time, but with knowledge instead of money.
Speaking of systematic approaches, Michael Burry's method during the 2008 crisis really shows the power of this concept. His detailed investment journals and analysis gave him that legendary conviction when everyone else thought he was crazy.
Well, what's fascinating about Burry is that he spent over 8,000 hours analyzing mortgage securities before making his big bet. That's what I mean by systematic learning. It's not just gathering information, it's about processing it in a way that reveals hidden patterns others miss.
That makes me think about Charlie Munger's mental models approach. How do you see his method differing from traditional investment analysis?
So here's what's unique about Munger. He's created this multi-dimensional framework where he actively combines insights from different fields. Like, he'll use evolutionary biology concepts to understand competitive advantages or physics principles to analyze market dynamics. Studies show that investors who use cross-disciplinary approaches like this generate about 40% higher returns over time.
That's incredible. But let's talk about the practical challenges. How do successful investors maintain these learning systems when dealing with information overload?
Well, Julian Robertson's Tiger Management program offers some amazing insights here. They developed this comprehensive system where analysts spent 20% of their time on structured learning activities. They would conduct weekly post-trade analysis sessions, maintain detailed investment journals, and participate in regular mentoring programs.
You know what's interesting about the Tiger Cubs? Their success rate is unprecedented. About 40% of Tiger alumni who started their own funds became billionaires.
Right, and what's particularly fascinating is how they adapted Robertson's framework. Take Chase Coleman, for example. So he took the fundamental analysis approach, but modified it for tech investing, leading to returns of over 21% annually for 2 decades. Or look at Andreas Halvorson, who expanded Robertson's risk management principles into this sophisticated system that's generated over $25 billion in profits.
So how do you think these learning systems need to evolve in today's world of AI and big data?
Well, the most successful firms are now using AI to enhance their learning systems, not replace them. For instance, Bridgewater Associates processes over 100 million data points daily to identify patterns, but they still rely on human judgment to interpret those patterns. It's about augmenting our learning capabilities, not automating them away.
That makes me think about how institutional learning systems are scaling these ideas. What are you seeing in terms of best practices?
The most effective organizations are creating what I call learning ecosystems. They're combining traditional knowledge management with new technologies. For example, some firms are using machine learning to analyze their historical decisions, finding that teams with structured learning systems outperform their peers by an average of 230 basis points annually.
Well, that's fascinating how the data supports the importance of systematic learning.
And you know what's really encouraging? Studies show that investors who maintain systematic learning habits for at least 5 years see their decision-making accuracy improve by about 35%. It's not about having some extraordinary talent. It's about building these consistent habits that compound over time.
That really emphasizes the importance of starting early and staying committed to the process.
Exactly. And here's what I find most exciting. Anyone can start building these systems today. The data shows that investors who document their decision-making process and review it quarterly improve their returns by an average of 18% over those who don't. It's about creating habits and processes that allow your knowledge to compound, just like interest in a well-managed investment account.
That's such a powerful way to think about learning and investment success.
And looking ahead, I think we're going to see these systematic learning approaches become even more critical. With markets becoming increasingly complex, the ability to build and maintain effective learning systems might be the single biggest differentiator between average and exceptional investors in the coming decades.